Great. So once again, welcome you all to today's section. So we're going to look at for the continuation. Okay, great. So we are going to look at for the question solving stage of lessee accounting. Good. The lessee accounting. And then basically look for some few questions. So in today's section, look for question solving on IFRS 16. We talk about leases. To be specific, we are looking at our lessee accounting. Very soon we will graduate towards lessor accounting. That is today's section. In our last meeting, we asked some few questions. So let's look at those questions and then start. So quickly, let's look at those questions. The question. Okay, so that is Lion Co. Question called Lion Co. It says that Lion Co. enters into 5-year lease of a building, which has remaining useful life of 10 years. Okay. The lease payments are $50 per annum, payable at the beginning of each year. So I'll be summarizing the important section of the question on board. So write that one here. So they are saying that the lease term is 5 years, not cancelable lease term. So lease term 5 years. Again, the annual payment, the asset useful life of the asset is 10 years. We said that the rights of the use of the asset need to be depreciated over the shorter of the lease term and the asset useful life. So if I want to depreciate the asset, it should be the shorter. So 5 and 10 is 25. Perfect. Then the next one, the annual payments. So lease payment is $50,000 and it's in advance. Perfect, in advance. Now the next section says that Lion Co. incurs initial direct cost of $20. So initial direct cost of $20,000. And receive lease incentive of $5,000. $5,000. So lease incentive. So incentives of $5,000. That's it. Let's continue. That is the second paragraph. There's no transfer of assets at the end of the lease and no purchase option. Good. So that means Lion Co. will not purchase the asset, meaning the asset will not be public transferred to Lion Co. So I don't think the Lion Co. remains not the owner, not the legal owner of the building. Good. The building have a 5-year useful life. You are leasing for how many years? 5. It have a 10 years, and you are leasing for how many years? 5. So at the end of the day, you are not the owner. So transfer the building back to the owner, or the title deeds will not be transferred to you. That is the section. Then the last paragraph states, on the last part one, the interest rate implicit in the lease It's not immediately determinable. But the lease incremental borrowing cost is what? 5%. That's what they're going to use. 5%. So that's the cost of what? Cost of capital, or the interest rate. So the interest rate is 5%. So the interest rate happens to be 5%. Interest rate 5%. Summary of the question. We are summarizing the question in there. Let's continue. With the value of $1 having a cumulative present value in 4 years' time as 3.46. So present value. This is the annuity factor for 4 years. Why annuity factor? Because initially all leases should be measured at the present value of what? Of the lease payment, plus any direct cost, less lease incentives, plus amount to be paid at the future period, which include what? Dismantle cost, cost of removing the assets, and site restoration. Don't forget about this. Good. So I can see some in this question. Okay. Then let's see. Then the value of $1 as a cumulative present value in 5 years' time. So 329. So that's the annuity factor for year 4. So I write it down. Annuity factor for year 4 and annuity factor for year 5. Year 4 happens to be 3.546. And then year 5 happens to be 4.329. We need this for the present value. Okay. Now the last sentence says that at the commencement date, Lion Co pays initial $50,000 and incurs the direct cost and receive the lease incentives. Good. At the commencement date, Lion Co pays initial $50,000 and incurs what? The direct cost and receive the incentives. Good. Now, so initial amount paid. Initial amount paid $50,000. Full stop. Now, down summarizing the question. So let's go to the board and start providing some few figures. So let's see. First, to calculate the items in here, tell us the financial position and tell us what the profit and loss, what will go in there. So I'll provide a formats and then I'll go and work them in. We said that anytime there's lease, tell us your financial position and then your P&L, what will go in there. Now, you shouldn't forget about the name of the company. So Lion Co. So the P&L, what goes in there, and your financial position. So your P&L. First thing that should probably go in the P&L is what? Your depreciation. The lease term is 5 years. But for this question, let's see the requirement. Okay, so we have to provide for the first year and then the second year. But we are going to provide for, let's say, all the 5 years. Even for all the 5 years, you need depreciation. So P&L, let's say year 1, year 2, year 3, up to last year. Financial position, the same thing, year 1, year 2, year 3. Kindly provide a space for this, because this is where we are going to reflect the items. So now we are not going to calculate what will be in here. First of all, it should be the depreciation. First is the depreciation. And now to get depreciation in this question, it's not straightforward. No, it's not straightforward. So that is all. Now, in our previous lecture, we saw that to get the initial value of the right of use assets, there are 4 items that we need to add. What are they? 4 solid items that you need to add before you can get the right of use. So I'll clear these ones, and we need to get them from this. So first of all, step 1, workings. That is workings. The first working that we have to do is the right of use. Now, the right of use, last meeting, we mentioned that it's comprised of 4 items. Number 1, that it must measure at the cost. Good. So the cost of the right of use comprises of 1, the amount of the initial measurement of the lease liability. That is the present value of the lease liability. And then any payment before the commencement date, and any initial direct costs, and then less any lease incentives. Good. And then any cost that will be incurred until the equipment. So in summary, if I summarize what we did last week, we said that A, B, C, D, the cost of right of use. First, it should be the PV of the lease payment. Find the present value of the lease payment. All these payments plus the initial payment before the commencement date. Less what? Less lease incentive. All these items are inside the question. Present value, find the present value of the lease payment. Find the initial payment. The initial payment is the 50,000 here. Less lease incentive. Lease incentive is what? The 5,000. The first one. Then we say C, any initial direct cost. So any direct cost. And there's one direct cost here. Initial direct cost of 20,000. Add it. And then you add any dismantle or removing cost of removing the assets. Removing cost or site restoration. Restoring the site. These are the 4 items that you need to look at for when you're looking for the cost of rights of use. Let's see this question. You have some energy. So let's start. I'll just tell the examiner. First thing I need to look out for is the right of use. So cost of right of what use. That's the first working. Number 1, it's made up of 4 items, in which we have 3 of them here. So let's see. The first item, present value, or in fact, it needs calculation. We can swap them. There's some straightforward one, which is the initial payment. Initial payment of what? 50,000. So the initial payment, which is what? $50,000. $50,000. Then direct cost, right? We are adding the simple ones. Initial direct cost of what? 20,000. Less what? Lease incentives, which is 5,000. Then left the big boss, which is the present value of the lease payment. That one, we need to find the present value. How do you find the present value of the lease payment? Now, they have given us an annuity factor. You know, the present value is always equal to the lease payment times the annuity factor. But here you need to select the best annuity factor, not any annuity factor. You need to get the right annuity factor. If you don't get the right annuity factor, you'll not be able to get the right present value. So now, how do you calculate the annuity factor? That's the question. Or how do you calculate? They've given us annuity factors here. Year 5 and year what? Year 4. Which of them are you going to select? Even though the lease term is 5 years, how am I going to calculate the present value? The lease term is what? 5 years. So how are you going to calculate the present value? Good. Now, the issue is this. Even though the lease term is for 5 years, we're looking for the present value of all the amount they're going to pay. So now the discount factor is 5%. We are going to produce, or we are going to solve this question in 3 different folds. All of them will give the same answer. What happened is this. This 50,000 we have recorded here, it represents the first payment. The guy is going to make 5 payments because the lease term is 5 years. But the first one does not need present value because this payment is in advance. So if the guy entered into the lease, let's say today, he has already paid 50,000. At the start of next year, that's year 1, you pay another what? 50,000. Another 50,000. So if you are standing here like this and you are looking for the present value of all the payments, the payment that the guy made now, what is the present value? It's still 50,000. And that is what we have kept in here. So let's how many payments the guy will make? 4. Because for 5 terms, you made 1 already. Okay. So that means we need to pick annuity factor for how many years? 4 years. That is the 4 years here. However, if this question happened to be arrears, then it will be 5 years. You have to pick annuity factor for 5 years. So in short, if you are going for 10 years, and you're looking for annuity factor, it's the same as annuity factor for 9 years plus the first payment. That will give you the present value. So these 2 answers will give us the total, these 2 answers. Okay. So let's see something in here. What happened is this. I'll try 3 different answers. Okay, so basically, that is how we are going to look out for. Although we'll stop using a second approach. So let's see the present value of the lease payment. This is the initial payment. This becomes the total liability. This becomes the total liability. Okay. So let's see the amount. So open the bracket. Tell them that the cash flow happened to be $50,000 times 546 agreed. Okay. And this will give us so that will be 117, but it should be 177,300. That is the total. Now we are going to look for a single. This is the total liability at the start of the year. These two put it together. So if I should end here, the total liability should be the 177,300 plus or 50,000. If you put these two together, that's the PV of the liability for 5 years. This is for 4 years, and this for the first year, making the 5 years. This becomes the total liability. But because the guy paid 50,000 initially, the liability left right after the initial payment is what? 177,300. Now, let me use this approach. Okay. Now, find for this factor. 1 minus 1 plus r to the power minus n all divided by r times 1 plus r. And then give me that factor. If you give me this factor, you multiply by 50,000, it will give us this summation of this figure plus this. Let's do something. So here will be 1 minus the rate is what? 0.5. Okay. The rate will be 0.5. So that is into bracket 1.05 to the power minus 5. Close it. All divided by 0.05. Then this times 1.05. Okay. Any answer? Let's point this on the calculator and let's see. Okay, so to calculate this by ourselves, a factor of this. I just want to prove something to detail. I'll get something like 50,000 times this. I calculate this. You'll get something like 4.546 agreed. Now let's multiply and see something. When we multiply this factor, so when you multiply this by this, you get answer of what? 227,300 agreed. So 227,300, which is the combination. This is the total liability at the start of the year. That is the present value of liability. So alternatively, instead of someone including this and this, you could have just calculate your own annuity factor. But that depends on the one examiner will give it to you. Because the one that the examiner will give it to you, you need to adjust it. But your own that you're going to calculate, no adjustment. And this answer is the combination of the 50,000 initial payment plus the 4 present value of the 4 payments, which we had 177,300. Meaning that if I add these two figures together, this figure and this particular figure together, I must get my total answer. So alternatively, let me take some part of the question away. So let me take this section away. Alternatively, someone will start by saying this. To calculate the cost, okay, I need my PV of liability. And that person will take the total liability of 227,300. 227,300. Perfect. Then the person will now add the direct cost, which is $20,000. Then the person will less lease incentives. Less lease incentive, which is $5,000. You and that person will get the same answer. So summing this one up, you get a total answer, and then we use that one. Good. So basically, that is the alternative calculation for the right of use. When the examiner presents a lot of items. Good. Basically, know the 4 items that make up the right of use. The 4 items. Good. So that is that. Okay. Now let's see something. At the end of the day, the present value we have for affinity. Sorry, 50,000 times 4. No. The old one, the 3 point. But we had 177,300. So what's the total? So total cost will be. Let's sum all up and let's see something. If you add all, I get something like 3.546. So 3.546. The same over here. 242. Over here 242. 300. So that is the alternative presentation. Any of them that you do perfectly right, you are done. Okay. Any of them that you calculate. So that is the cost of the asset. So your depreciation is based on what? This value. Depreciation is based on this value, not any other value. So now depreciation will now continue from there. Now let me provide some short trial balance.